Thank you very much for joining us. This lecture is in continuation of our previous lecture. As we discussed earlier, a company has corporate objectives, and these corporate objectives are to achieve key factors of business success. And to achieve these objectives, companies develop a corporate strategy. So what are these key business factors? You can see here, these are the key business factors: profitability, market share, growth, cash flows, profit, customer satisfaction, quality of the firm, products, industrial relations, added value. So these are the key business success factors, and corporate objectives are always in line with these factors. And corporate strategy is developed to achieve the corporate objectives. On the other hand, one of the legs of the corporate objectives is financial objective. And the financial objective, a core objective goal of the financial objective is to maximize the wealth of the shareholder. And to maximize the wealth of the shareholders, management develops a financial strategy. Now, few questions are striking my mind. The first is, might be you will be thinking on the same pattern as well. First, from where this wealth maximization comes? Being a shareholder, we have just discussed the core objective of the financial objective is to maximize the wealth of the shareholder. So now the question arises, from where this wealth maximization comes? Second, how to measure the value? How will you measure the value? The wealth has increased, decreased, how will you measure it? Third, how to measure the total wealth maximization of the shareholder? Fourth, what is the strategic process businesses follow to maximize the wealth? These are the 3-4 questions basically. From where this wealth comes, how to measure the value, how to measure the total wealth maximization, what is the process businesses usually follow to maximize the wealth of the shareholder. So we will address these 4 questions in this lecture. The first thing is, from where this wealth maximization comes. Being a shareholder of the company, they are getting return in the form of dividend. This dividend is a revenue for the shareholder. At the same time, they are getting capital appreciation in the price of the shares also. This is called capital gain for the shareholder. So this is increase in assets of the shareholder. So we can say shareholders' wealth comes from 2 ways, either dividend or capital appreciation. Now the important thing is, if the shareholders are getting dividend, they are getting capital gains without taking further business and financial risk. It will be the outstanding situation for the shareholders. The second question is, how to measure the value. How will measure the value? There are 3 different approaches. First is statement of financial position. Second is breakup basis, and the third one is market value basis. Statement of financial positions, we can take the balance sheet. From the balance sheet, we will assess the value. We will assess the value through the retained earning. So if the retained earning has gone up, means wealth of the shareholders has gone up. Breakup basis, this method is usually used when the business is threatened for liquidations or businesses wanted to sell some assets. We will not discuss in detail here. This is not our core objective. The market value, this market value method is the true representative to assess the value. There is a possibility that the entity is a listed entity. There is a possibility that the entity is a private entity. For the listed entity, we can assess the increase in share price. It will be considered a capital gain. For the private entity, it will be very difficult to assess the value, increase in value of the private entity, but still the core objective of the financial management is to maximize the wealth of the shareholder. How can we measure the total wealth maximization? This is our third question that we addressed in the beginning. So this is a very small formula that measures the wealth maximization of the shareholder. This is P1 minus P0 plus D1 whole divided by P0 into 100. So this P0 is the price at the end of the year. P1 is the price at the end of the year. P0 is the price is the beginning of the year. D is the dividend that has been given to the shareholder. P0 is the base price at which the shareholder had made the investment. So basically, assuming shareholder has made an investment at the beginning of the year, then during the year shareholder might be getting dividend, might be getting capital appreciation. Dividend plus capital appreciation, both are the return for the shareholder. So if we are dividing this return with the base price or investment, definitely it will give us the total increase in wealth of the shareholder. Let's take this example. A shareholder purchased 1000 shares in SG on 1st January at a market price of 2.5 per share. On 31st December, the ex-dividend market value is 2.82. So the shareholder invested at 2.5, the price has gone up to 2.82. The difference is capital appreciation, keep in mind. The dividend paid during the year is 0.27 per share. This is the dividend. This means this is the revenue of the shareholder. What is the total shareholder return and what are the elements of the total shareholder return? So this is a very simple solution. So what is P0? Price at the end of the year 2.82. P1. P1 is the price at the end of the year. P0 price investment at the beginning of the year. D0 is the dividend that shareholder will get it. So just we need to plug the numbers in the formula. So revenue of the shareholder is 2.82 minus 2.5. P1 minus P0 plus D1. This is the total return shareholder is getting divided by the investment they made at 2.5. The return is 23.6. Now this 23 point, the revenue of the shareholder is 0.27. Now the revenue. How much is the revenue of the shareholder and how much is the capital gain? Revenue, dividend is the revenue. If we are dividing the dividend with the P0, then it will give us the percentage in revenue. And if we are dividing the capital appreciation with the investment, then it will give us the capital appreciation percentage. This is my revenue, shareholder's revenue percentage. This is shareholder's capital appreciation percentage. The total of both these is 23.6. This is the wealth maximization shareholders has got over the period of time. Now fourth question is, this wealth maximization, it will go through some process. And this process is, they will set the financial targets, develop business strategy, implement business strategy, monitor the results and measure the performance. This is called a strategic process because companies definitely they will focus on the financial objectives and a lot of their time will be devoted on the financial objectives. So there is not such a big difference in between the financial objectives and the corporate objectives. So this is the 5-stage process. Now we will learn how this 5-stage process will be implemented. First, profit maximization. Setting of financial target, as we discussed in the setting financial targets. How they will set the financial targets? While setting the financial targets, they can set the financial target based upon the profit maximization, earning per share growth, restriction on the gearing level, profit retention, operating profitability. So when they are setting, suppose it has been decided by the management, we need to increase the profit by 20% every year. So this is a financial target. What is the best thing? This is very easy to implement, easy to communicate. People will be able to digest it. But the problem is this profit can be increased due to more investment. More investment will come, profit will go up. And ultimately, profit per share it will be impaired, but overall profit has gone up. So people recommend that they need to set the target based upon the per share indicator instead of the total profit. So the best per share indicator is earning per share. So common measure profit per share is the EPS, earning per share. When Group EPS by target amount each year. So group EPS by target amount each year. So group can set the target every year how much EPS they need to generate. It basically increase in earning per share, ultimately increase in profits. So higher EPS means higher profits, higher dividends, higher retention, higher growth. But the problem is this problem with this model is based on the past data, figures can be manipulated. These are the two negative things. How they can set the financial target from different other levels. Different other level they can say restriction on the gearing. Debt equity ratio should not be 1:1. Dividend cover ratio they can set up to a certain amount. So these are the helpful. In the same way they can set the financial target based upon the profit retention. How should be the payout ratio, how should be the retention ratio, they can set it like this. Operating profitability, profit to sales ratio, like return on capital employed, they can target it as well. These three mechanisms, as I mentioned, these are not primary financial objectives, but these can act as a subsidiary target that can help to achieve the financial objective without incurring excessive risk. So this is how they will, first of all, they will set the target, they will set the direction for the entity. Okay, this is our target, this is our direction. Now we need to work it out and we need to develop a business strategy to achieve these targets. So assuming 25% growth, it was the target. Then they developed the strategy. When they developed the strategy, back and forth process, long-term goals, milestone, urgency, business models, then they will go into each area. They will develop the strategy, each division of the business, each section of the business, you can say like this. So once they have developed the strategy, then they will go for implementation. In the implementation, they will set departmental goals first at the company goals, then departmental goals, employee goals, JD, performance appraisal. Then they will communicate and align, drive accountability, create focus, be action oriented. All these basically, first they decided they need to increase the 20% profit. Then they have charted out at a departmental level. Then they made the person responsible for this. Then they have communicated it. Once they have communicated it, they will launch it. And after the launching, then they will monitor and measure the performance. How they can monitor and measure the performance? Variance analysis, ratio analysis, comparison forecast, comparison with the budget, comparison with the historic results, comparison with the competitor and industry. So whenever the final results will come, it will always be compared with the history, with the competitors and the overall industry. So this is, and now we will focus on it. This is important for us, how to perform the ratio analysis to monitor and measure the performance. Ratio analysis can be classified into 4 categories. This is profit-based ratio analysis, DE-based, debt equity-based ratio analysis, liquidity-based analysis, and shareholders investment ratio. In the profit-based analysis, we will see return on capital employed, return on equity, and other profit ratio like GP ratio, net profit ratio, operating profit ratio, cost to sales ratio. In the DE ratio, we will discuss in detail in the chapter number 15. What is the best DE ratio for the company? Liquidity, we will discuss all in detail in chapter number 4. It will be our next lecture. Hopefully, we'll start from the working capital. It will be chapter number 4. The shareholder investment ratio, dividend yield, earning per share, PE ratio, dividend cover ratio. These are the shareholder investment ratio. The first is return on capital employed. What is this return on capital employed? Very simple words I will say. How effectively the company is utilizing its capital. How effectively capital is generating the profit for the company. So this equation is return on capital employed is equal to profit before interest and tax divided by capital employed into 100. Profit before interest and tax, very easy to calculate. We know this. Capital employed, equity plus long-term debts, or we can say total assets minus current liabilities. Where possible, please use average. If the data has been given opening and closing levels, try your best to use the average capital employed, which is equal to opening plus closing divided by 2. Results should be compared with the previous year, industry and competitor. We have already discussed. The biggest positive is simple and easy to calculate. Biggest negative is it consider the book value of the capital, not the market value. And second biggest is consider the non-cash items as well, which are depreciation, amortization. So let's start with this example. This is example of the return on capital employed. This is the beginning of the data given. This is end of the year data given. Profit before is tax is 210,000. Income tax is 65,000. Interest is 30,000. They are asking to calculate return on capital employed. We know this return on capital employed is equal to profit before interest and tax divided by average capital employed. Here average capital has been given, opening has been given, closing has been given. So I will apply how we'll calculate this. Return on capital employed is profit before interest and tax divided by average capital employed into 100. Profit before interest and tax is 210,000 plus 30,000. This is the profit after tax. So interest will be added back. So 240,000 divided by average capital. Average capital is 1 million plus 1.4 million divided by 2. In average capital is 1.2 million. So 240,000 divided by 1.2 million is 20%. This 20% will be compared with history, competitors, and industry. Based upon this, overall decision, overall assessment will be made where is the company standing. Next, return on equity. Return on equity, basically return on capital employed considers how effectively capital has been used, and return on equity considers how effectively equity has been used, and we can say in my return on investment against the investment by the shareholder. In other words, we can say company's profit as a percentage of combined total worth of all ownership interest in the company. Return on is equal to profit after tax divided by equity into 100. If the equity at the beginning, at the end is given, please use average equity. Profit after tax is the most suitable measure as this amount is available for payment in the form of dividend to the shareholder. This makes very logical. Equity and what is the profit available to the equity holders. So equity is the share capital, share premium or retained earning, or we can say this is total assets less total liabilities. Where possible, please use average equity. Result should be compared with the previous year, industry and competitors. Biggest positive, simple and easy to calculate. Biggest negative is also consider the book value of the equity instead of the market value, and moreover is consider the non-cash items as well as we discussed. Depreciation, amortization. Let's apply this. Again, this is the same example that we discussed earlier. So now we need to take profit after tax divided by average equity. So this is my profit after tax divided by average equity 100. Profit after tax 210,000. This is before tax. I will deduct the tax. It will give me profit after tax 145,000. Average equity is 850,000 and return on equity is 7.05. Again, it will be compared with the three things that we discussed. This will be history, competitors, and industry. Other profits ratio. This is basically page I have taken a scanned copy from book. This you can see in this they have calculated other ratios as well, like this. In the first year GP margin was 40%, in the second year it was 45%. This reflects some sort of positive. On the other hand, if you will see cost as a percentage of sales, first year cost was 60%, it has gone 55%. Cost GP as a percentage 40%, it has gone 44%. Overall 100%. Expenses 30%, 35%, 10%. This is the alarming situation. You know, expenses has gone up by 30% to 35%. So these are the indicators as well. Basically, while assessing the performance of the company, we can see GP ratio, net profit ratio, operating profit ratio, COGS versus sale. In the same way, expenses versus sale, different yardstick we can apply to assess the overall performance of the company. This is a dividend yield. Dividend yield, basically this is the return that a shareholder is expecting on the share of a company. Dividend yield is the estimated 1 year return of an investment in a stock based only on the dividend payment. Basically, when being a shareholder, someone will invest in the company and they will be expecting dividend. So their return can be assessed based upon the dividend yield formula. So dividend yield is equal to dividend per share divided by price per share. We can say DPS divided by PPS. DPS, dividend per share, PPS, price per share into 100. Most recent period previous dividend per share we need to take. Calculate X dividend market price per share. X dividend is equal to cum dividend less dividend per share. So this is a very small example. We'll see. In the year to 30th September 2008, an advertising agency declared an interim dividend of 7.4 cent per share and the final dividend of 8.6 cent per share. So two dividend. One is the interim dividend, one is the final dividend. Assuming an X dividend share price is 315 cents. So what is the dividend yield? We know that we have already discussed DPS divided by PPS. Dividend per share divided by price per share. Dividend per share is 7.4 plus 8.6. Price per share is 3.315 cents. So this is a very straightforward solution. This is DPS, this is PPS, this is dividend yield. So shareholders definitely they would be expecting a return of 5.08% on the share that they are already holding. So earning per share is basically calculated as a company's profit divided by outstanding shares of common stock. Profit attributable to the ordinary shareholder divided by weighted average number of ordinary shares. This is the same thing, profit number of shares. The resulting number serves as an indicator of the company's profitability. Higher a company's EPS, the more profitable it is considered. Yes. This is a very small example. Walter Wall Carpets made profit of 9.320 tax amounted is 2.8 million and company's share capital is 10 million and preference dividend at the rate of 8% preference shares dividend. So calculate the EPS. This is we need to calculate the EPS. We know the EPS formula is profit after tax divided by weighted average number of shares. So this is profit before tax less tax. This is profit after tax less preference dividend. Then earning attributable to the ordinary shareholder. This is basically profit after tax. What is available to the ordinary shareholder divided by number of shares. Average is 63.6 cent per. This is share. Basically this is earning per share. PE ratio is the ratio most important yardstick for assessing the relative worth of the share. This is important ratio because it is relative to two key considerations for investor: the market price of a share and its earning capacity. This ratio basically tells us what is the market price of the share and what is the capacity of the share to generate the revenue basically. So PE ratio, this is sometimes called the earning multiple or price multiples as well. PE ratio is equal to PPS divided by EPS, price per share divided by earning per share, or total, we can say total market value of the equity is your total earning. This will also give me the, so it helps to determine the total market value of the equity as well, because total market value of the equity is equal to earning into PE ratio. A company has recently declared a dividend of 12 cents per share. This is recent dividend. Share price is 3.72 and earnings for the most recent year 30 cents per share. Calculate PE ratio. We can calculate PE ratio, price per share divided by earning per share. It will give me the PE ratio. This is price per share, market price, earning per share. Price per share is 3.6. Yes, this is 3.6 price per share. Okay, we know this. This is price per share divided by earning per share, and price per share, this is the market value X dividend price. The given price is 3.72. This 3.72 is the cum dividend price. We need to deduct the dividend, and dividend is most recent dividend is 12 cent 0.12 is equal to $3.6. This $3.6 is the price per share, and earning per share is 0.3. So the PE multiple is 12. Now as we discuss, it helps us to determine the new price per share. As initially earning per share was 30 cents per share, now new earning per share is 33. So if we are multiplying 33 cents with the PE multiple, 33 cents into 12, which is P multiple, the new share price that we're expecting, it will be 3.96. That's why this is called a helpful tool to assess the new price per share based upon the revised earning per share. Thank you very much for joining us. I'm pretty sure it will be quite informative lecture for you. In our next lecture, we will start our discussion with the working capital. Stay safe, stay blessed.